Well, good morning, everyone. So my name, as Marty says, Julian Brigden. We started Macro Intelligence 2 Partners over 10 years ago now. And we built the thing organically, basically advising everyone from sort of the macro hedge fund community through to family offices, wealthy individuals. And we take a very active kind of approach to the world. We like to present, as we're going to do here, the kind of 30,000-foot view of the world. But I don't think that pontificating about the economics is really got that much value unless you try and make money out of it. So that's exactly what we do. And we try and come up with trades and ideas and investment themes for our clients. And we've been very good at catching some of these well ahead of the market. 2021 in January, we wrote that inflation was going to be the biggest issue of the year, that it was going to approach double digits. And we were told by people that we were idiots. 4 years later, we're still grappling with that issue. And that's one of the themes that I want to address in this piece, in this presentation, which I've called Goldilocks, Not as Easy as Everyone Thought. So before we dive into where we are now, I want to just summarize some thoughts as to where we were at the end of last year. So if you look at the end of last year, we had the markets that were high on Goldilocks. At the time, we explained that the odds of a Goldilocks outcome were the statistical minority. Why? If you look at various Fed tightening cycles going right all the way back to 1960, you will see that we've had 12 tightening cycles, with perhaps the exception of Paul Volcker in the 80s. In all of those, the Fed approached them with the intention of delivering a soft landing, but it is extraordinarily hard to do. Of those 12 tightening cycles, we've arguably only ever had 4 soft landings, and you can see them here highlighted 1, 2, 3, 4. 3 of those notably occurred with significantly higher levels of unemployment than the current one. In fact, only number one, 1966-67, did we attempt to re-accelerate growth with the current level of unemployment, and it ended very badly. It did not deliver true Goldilocks. Now, to up the odds of trying to achieve Goldilocks, we explained to all our clients 2 years ago, and the market still hasn't cottoned on to this, that they were going to pursue a policy referred to as opportunistic disinflation. This policy framework has only been attempted one other time in history, and that is in the mid to late 90s, which you can see here highlighted in yellow. What does this mean? It means that versus a typical tightening cycle that would normally see Fed funds rise to at least 100 basis points over nominal GDP, which is what this chart shows you, right? Nominal GDP at the moment is running around 6. So we would have at least Fed funds of 7. We stop short of that. You hold them slightly lower than would be the typical scenario, which is what you can see here, as I said, in yellow. Bear in mind, it was also where we stopped in 66, 67. Now, the fact that you don't raise rates as much as you would in a typical tightening cycle doesn't preclude rate cuts. We got rate cuts in that late 1990 cycle, which you can see here highlighted in yellow. But ladies and gentlemen, they were tweaks. In the late 90s, we got 75 basis points of tweaks over a 9-month period. And then the Fed went on hold for the next 30 months. Because this is the point. If you've never taken rates sufficiently high to guarantee that you have killed inflation, which usually means killing the economy and delivering that hard landing, the trade-off for that lower terminal rate is higher for longer. And just because you get a couple of tweaks does not mean that in the next few years, the Fed is going to follow through unless we get that hard landing. Now, the other thing that we got in the late 1990s, and perhaps we can get it again, and this was really the get out of jail free card, was we got a massive productivity boom, which you can see here. That productivity boom enables you to create nirvana. It enables you to run extraordinarily rapid nominal GDP, running around 6%, 5.5% to 6%. That's great for the equity market because the equity market trades off nominal activity. It enables you to lower inflation, which is great for CPI, and it enables you to lower unemployment and raise average hourly earnings, which is great for the real economy. But as I said, note, you went into this with average hourly earnings closer to around 2.5% and your unemployment closer to 5.9 to 6%. So your starting point was a lot easier in the late 90s than it is now. But that all sounds great. But there are two risks in this scenario, because you do have to hold rates, as I said, higher for longer. The first one is that you lose employment momentum. Unemployment is a momentum indicator. Why? Because you can run a moving average over it. The 27-month moving average in the US has always marked, once you cross it, the beginning of a recession, all the way back for 75 years. Once you've crossed that moving average, ladies and gentlemen, you've always, always, always had a recession. The exception was 1966, 67. Okay, so at face value, the odds are we have a recession. Now, the second risk is that you let your foot off the brakes too soon. And this is exactly this 66, 67 scenario. Because what you can see here is in the early 60s, we had a period of extended low inflation. We then get an unnecessary pro-cyclical fiscal boost, courtesy of Johnson's Great Society, which drives inflation out of its range. The Fed hike, but the stock market drops, and we get a mini credit crisis and they ease. And unemployment never loses that momentum. It tracks sideways for about a year, and then supported by ongoing government spending, it tries to fall again. Average hourly earnings pick up again, and inflation comes roaring back. This is that example one I gave you that wasn't truly a Goldilocks soft landing. So based upon the last 12 tightening cycle, ladies and gents, the odds of a Goldilocks scenario are at best historically 25%. The base case is a recession, and there is a risk that if you let your foot off the gas too quickly, the economy reaccelerates and inflation comes back.
Hey, Julian, before you give your answer to your question, can we just go back to the jobs numbers that you had, the employment numbers?
This one?
There's a lot of questions around the quality of jobs that are being created. A lot of part-time jobs are created. Most of them aren't head of household jobs. Do you want to make a comment on that?
Look, Marty, I think there's a lot of questions around this unemployment metric period at the moment, right? Particularly with the immigration story. And I think the picture is muddy. That's why right here, right now, I haven't called a recession. I'm more concerned about it. I'm watching the metric. It's making me more tactical in some of our trading calls and our market calls, but I haven't called it.
Right, because I think that like California recently restated their employment numbers for 2023 to the extent that there were no real job gains. So
right.
I'm just saying the numbers are questionable, but
yeah, absolutely. And I think the big thing you have to see, and we'll talk about that in a second, is you have to see layoffs, and you're certainly not seeing any signs of that at the moment, Marty. Okay. So let's look at where we are now. Well, at face value, ladies and gentlemen, we have Goldilocks. We've had nominal GDP fall, but it remains extraordinarily high at 5.4%. And that is extraordinarily high, ladies and gentlemen, right? 5.4% is pretty much commensurate where we were in the early 2000s when the Fed was hiking rates aggressively, okay? But the good news is CPI has fallen faster, and hence real growth has reaccelerated. We also have a labor market, okay? And what I like to use to measure the labor market is aggregate weekly payroll. As the name suggests, this is an aggregation. It takes the number of people working, how many hours they work, and how much they earn an hour to come up with a number. And you can imagine that's pretty much take-home pay for the US economy. So it correlates, as you can see, unsurprisingly well with nominal GDP. So we have a labor market which at present is still commensurate with 5.5% nominal GDP. Okay?
If somebody's logged in here, you have to put yourself on mute so we don't get an echo. Anyway, keep on going. Keep on going. Julian, keep on going.
Yep. The problem is, ladies and gentlemen, absent productivity, absent that late 90s productivity gain, 5.5% nominal GDP is not sustainable. Even in the wildest dream of every equity bull, if you walked in tomorrow and CPI was 0, but nominal GDP was 5.5%, then real growth would have to accelerate to 5.5%. And we simply don't have the workers to support 5.5% real GDP growth and not stoke wage inflation. And for all the hype around AI, there is literally zero sign of a pick-up in productivity. Very atypical to what we saw in the 90s, where productivity picked up. Productivity over the last 3 years has fallen. And that was...
Julian, we have a question here.
Yeah.
I'd like to ask you, can you correlate, because inflation has been cumulative, inflation close to 20% over the number of years here. How do you correlate the current situation given that circumstance? How is inflation going to come down? Is it through a change in energy policy? I'm looking for...
No, it's productivity. There's two ways. Productivity or unemployment.
How is inflation going to come down?
Yeah.
How is the Fed going to get inflation down with policies that are increasing inflation? You're looking at 20% cumulative.
Yeah, absolutely. So you've got one of two ways. You have a productivity boom, which will enable us to run rapid nominal GDP, potentially faster than debt servicing, which would be an ideal scenario, and enable us to pay people more money so that gradually through time they earn their way into that 20% shortfall, or they recoup that 20% shortfall. So that's the ideal scenario, okay? The other scenario is very simple, a recession. That's it.
What's the likelihood of the first scenario?
Well, we don't have any evidence at the moment. There's zero. I think there's a lot of hype around productivity AI. I think it will ultimately deliver. But the implementation stage, we just saw a company like McDonald's abandon. And if McDonald's can't do it, with something as simple as ordering chicken nuggets at a drive-through, right? How are we going to implement all these things? Not within the next 5 years, because sure, we can do it then. But we need this in the next six months, 12 months. Because the problem is, ladies and gentlemen, is that we were already running 5.5% nominal GDP even before the recent easing of financial conditions. If anything, financial conditions suggest that we are going to see a re-acceleration in nominal GDP. And if we see a re-acceleration of nominal GDP, it continues to justify equity valuations because S&P margins and nominal GDP are the same thing. And if you continue to underpin the equity market, you will continue to underpin the wealth effect that is driving this economy. Ladies and gents, we have created close to 200% of GDP in wealth in the last 4 years. Those are mind-boggling numbers. Is it any surprise in that scenario that we have a two-speed equity market and a two-speed consumer? Look at the difference between the confidence of consumers with equity holdings of over $500,000 and those with little or none. These are unprecedented extremes.
But Julian, can I just ask you, I mean, there's no departure between the two, right? I mean, it's not like one becomes ascendant and decouples from the general economy, right?
Oh, no, they do. They do, Marty, right?
You're saying they can decouple or they can't decouple?
They can become decoupled. They have become decoupled. Now, there is a common element which could recouple them, but at the moment, they've utterly become decoupled because what drives, look, the nasty truth is, okay, that the 80% do not matter. As long as they have a job, they will spend all that they earn. And it doesn't matter whether they spend it all on food or whether they spend it all on healthcare costs. From a GDP perspective, it doesn't matter. Surely from an equity selection perspective, it matters. The only people that matter are the people with discretionary income, and their wealth is absolutely unprecedented. And they are the drivers of marginal spending. Right?
Yeah, they're nominal wealth. Got it.
Now, you can see, if you want to see an example of an extreme example of the fact that we refer to as hyperfinancialization. So in other words, it is not the real economy that drives stocks, but stocks that drive the real economy. Okay, look at the conference board question on the percentage of Americans looking to take a foreign holiday within the next 6 months. It is running at currently 20%. That's pretty impressive since only 48% of Americans have passports, right? It is the S&P, right? It is the S&P. So this rise in equities, this unprecedented wealth effect is driving discretionary spending. But the big problem is that this hyperfinancialization, this leading of asset prices, leading economic behavior is the biggest risk for the inflation story, not via consumers, but via the behavior of CEOs. Because if you look at the relationship between the equity market, in this case, the NYC composite, and total employment and CapEx, then it leads both. And at current levels, we should not expect a slowdown in economic activity. We should expect a re-acceleration in the second half of the year. And in that scenario, ladies and gentlemen, wages are likely to remain extraordinarily sticky. Our model, which leads by about 8 months in this situation, you can see suggests wages sticky at around 5%. And if wages remain sticky, just follow along with me, then core service inflation, so ex-energy, is likely to remain sticky too. And if core services remains at about 5%, can we really expect that much progress on core CPI? Because what has driven core CPI, okay, or what drives it, 2/3 of it is core services. And what the market, bond market and equity market has got extraordinarily excited about is this recent decline in core CPI, which has been utterly driven by core goods. Core goods, ladies and gentlemen, is now falling at its second fastest rate, only exceeded by the post-dot-com bubble period, in 46 years. This is all this improvement in inflation is a core goods event. Core services have been above 5% for 7 months. And the problem is, ladies and gents, starting next month, the base effects that have been so extraordinarily beneficial, which have taken 1.2% off the year-on-year rate of core goods since the start of the year, start to reverse very, very strongly. We just got Canadian CPI out, and it came in way stronger than people expected. I haven't had a chance to analyze the number, but I suspect we're already starting to see that effect of these base effects drop out. Jay Powell referred to it. It's one of the reasons that they are not in such a hurry to try and ease, because they understand that if this thing starts to reverse for goods, the progress on core CPI will at best stall and at worst could reverse higher. Furthermore, this re-acceleration of inflation is corroborated by the fact that financial conditions have eased so much since the end of last year. Financial conditions tend to lead the rate of net change in CPI. And you can see here that it doesn't look that bad, right? It suggests 1.7% CPI by the time we get to December, actually probably a bit earlier than that, September. But here's the problem. That's the net change. So you have to add that 1.7 onto where CPI was same time last year. And that could get you close to 5% headline inflation again. And indeed, if you go back,
question?
Yeah, just let me finish this one, Martin.
Okay. Yep.
Indeed, if you go back to the 1960s and you look at the spread between that core CPI, the core services CPI and headline CPI, whenever they get extraordinarily extended, so 2.5% or more, if we get a recession, which we got here, here, and here, both will drop. Okay? But that requires a recession, because absent a recession, what happens is headline inflation rises, 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 and rises. So the base case, ladies and gentlemen, is that far from being too soft and slowing down, the risk is, with asset prices where they are, supporting consumer spending and CEO optimism, the risk is that inflation will actually re-accelerate as nominal GDP re-accelerates. And in that scenario, you can absolutely forget your rate cuts. Questions?
So there's a question from the audience. How do you see the roll-off of fiscal stimulus factoring in?
I think that becomes an issue, but only in starting in 2025 and slowly.
Can you go back to your chart of this that we had talked about, of this bifurcation in economics by the people who hold lots of stock? So a lot of the stock market gain is because of these 7 or 6 companies.
Yep.
You know, NVIDIA, et cetera. So, but the rest of the stock market is pretty, I don't think there's a lot of growth in it at all, right?
No, I mean, we know that, Marty, right? But the problem is most people own some sort of trackers to some degree, or, you know, we know that passive investments picked up as percentage. Also, people, I'm sure a lot of you, right, as family offices, get calls from some of your clients saying, why don't you own more NVIDIA? Right? So individuals tend to play these momentum games, right? So it's, and look, I'm not saying that if they all owned NVIDIA, this chart would even be probably more extreme. But the reality is that, excuse me, these are unprecedented divergences, right? And it talks for a bifurcated stock market and a bifurcated economy, which is heavily dependent on equities. And here actually is where I want to shift focus a little bit, because, as I said, what I've told you so far suggests that far from slowing, okay, we're actually going to reaccelerate the economy. But the problem is this is a very, very fragile setup, because, and what really alerted to us to this was a rapid, and I mean extraordinarily shift in the tone that we got in the S&P PMI manufacturing survey in the month of April. So 1st of April, they deliver their preliminary report, and then they follow it up every month around the third week, end of the third week, with their final report. And in April, the tone changed on a dime, right? Literally on a dime. On the 1st of April, their commentary were further encouraging improvement, expanded at a solid pace, broadening out of the upturn, reviving demand, picked up and gained confidence. 23 days later, the tone was the following: lost momentum, below trend, pace may be lost, business fall, expectation slipped, and challenging environment. The only difference, ladies and gentlemen, between those, in those 3 weeks, was the S&P was 5% lower and 10-year yields were 40 basis points higher, as we assumed fewer rate cuts. And what worried us about this was we worried that a lot of the strength that we had seen was not real strength, not concrete activity, but hopium predicated on assumed rate cuts that the Fed cannot deliver. And now we're in a much more delicate balancing scenario, where actual Fed policy, to take a line from Tim Fiore, the chairman of the ISM Manufacturing Survey, has turned from being a tailwind to a headwind.
Yeah, so just a couple more comments, Julian.
Yeah.
So because I belong to a lot of different groups that talk about this kind of stuff, and I'm just, my conjecture was that part of the reason why the market is still doing well is that, I mean, Europe is really down for a while now. I think a lot of it has to do with U.S. stock market is a safe haven for institutions. Do you disagree with that, or?
No, I mean, I think, look, there's a bit of a circular chicken and egg thing here, Marty.
Exactly
right.
Yes.
There's an actual need for us to have strong capital inflows into the US, and the reason we need them is we need them to fund a record current account deficit and budget deficit. So there's an element of mechanics here, Marty, which dictates that we have foreign inflows. Otherwise, we couldn't be running these deficits, okay? And they have to go into something. Well, they're not going into treasuries to the same degree. They are going into 7 stocks.
Right. And then secondly, I mean, I don't see AI as being such a great thing. Again, wasn't a great thing for IBM for many years, right? But it doesn't fill in potholes, right?
Well, I mean, look, we will see. I mean, I do think that AI will be very productive once we figure out how to use it. It may not be how we think we're going to use it, but it should be. But from a Fed perspective, what counts is the next 6 to 12 months, right? I mean, Chris Waller is one of the few governors who's talked about this, and he said he thinks it's at least 5 to 10 years away.
I think in the short term, it's a massive job destroyer. But anyway,
we'll see. But then that brings us to this, Marty, right? So we've tried to look at some of as I said, the employment metric is complex because of immigration, okay? So we've tried to look at signs of weakness, because we're already starting to see companies start to pare back on hiring. It's not weak. They certainly aren't laying people off. But when people are leaving, we had 2 comments in recent PMIs about firms not what they refer to as backfilling. So someone leaves and they don't immediately replace them. And the problem is when that starts to happen, Marty, you start to see things like this. This is a sign of weakness. This is the percentage of employees who are put on part-time work for economic reasons, right? And you can see it's above its 34-month moving average, which historically has been a recessionary sign. Furthermore, we are starting to see worrying signs build up in the labor market as it relates to construction. And construction is important because it leads the economy. Okay? It leads overall employment. And what's happening is with this number is inverted. This is the month's supply of new homes hitting the market. It is growing very rapidly. We built an unprecedented number of homes, or we started them over the last few years, and they are just hitting the market, and they are not selling as quickly as we thought. So the risk is that builders will start to curtail new projects going forward. We're already seeing a collapse in multifamily activity, and it could well come to the single family space. And furthermore, we've already started to see some weakness in the PMIs below levels which are historically recessionary. So the point is to go back to this, and this is what I was trying to span here. If we live in a world where the US economy is predicated on ongoing equity appreciation to keep the wealthy spending and to keep companies hiring and not firing, then we have an enormous fragility at the heart of the system, Marty. It is utterly dependent on the equity market. And if the equity market were to wobble, we'd be in trouble. And indeed, I think the risk is that we actually face the same problem that only two central banks have been genuinely honest enough to admit. And they are the RBNZ, which I've cited here, and the RBA. And basically what both of those central banks have admitted, that if they want to defeat inflation, this is what the RBN governor is quoted as saying here, the cost will be higher unemployment. So the Fed does not have a choice. They either have to choose the devil or the deep blue sea, a recession or higher inflation. You cannot, the odds of you achieving both are highly, highly unlikely. And this is a problem, and this is the cutting edge bit, because the markets are betting 110% on Goldilocks. So if we start with fixed income, we'll run through this quickly. The US, if you look at the front end of these curves, and these are pricing September of this year versus September of next year, is expecting, and you can see this in here in white, more rate cuts than either the UK or Europe or Australia, right? We are expecting more rate cuts in the US. Just think about that. With the strongest equity market in the world and the strongest economy, we are miraculously expecting more rate cuts than anyone else. Now you could say, is this the bond market being all pessimistic and thinking this is a recession? And the answer is no. Because if the bond market was forecasting a recession, you would see a bull steepener as 2-year yields dropped faster than 10-year yields. What we currently have is a bear steepener. And a bear steepener is when 10-year yields rise faster than 2-year yields or don't fall as fast. And what you have here is the steepening, which is itself an expectation of falling inflation, but re-accelerating growth. Now, we've just questioned whether that falling inflation is correct, and this could come as a big shock to bond markets. In that scenario, ladies and gentlemen, it is utterly premature to assume that 5% is the high in bond yields, right? We're on the record from 2016, and absent COVID, we would have been right. We were long bonds going into COVID, so we were safe. But the long-term trend for US bond yields for the next 30 years is up and to the right. We have run numerous seminars with clients talking about a phenomenon that we do not believe is baked into the market at all. And that is that the biggest problem facing global sovereign bonds and all global bonds going forward is not excess supply, it is shrinking demand. And that shrinking demand is a function of demographics. As countries age out, and the savers that drove the rally, the boomers that drove the rally from the early 80s all the way into the mid 2000s and teens start to retire, they dissave, they sell the assets which they've corrected here. And the only marginal buyers of providing of savings in the world now is China, and they are not our friends. So if you want to get right? If you want to realize what's going on, we are in a structural bond bear market. Now,
So just one quick question, Julian. So you're saying the floor is 3%?
I would say 3 in a recession is about as good as you're going to get, Marty, because typically if you look here, what has driven you off those previous highs was a 20% drop in equities and a recession, the dot-com bubble and a recession, the GFC and a recession. The exception, 1995, 1996. Have we got that productivity boom? Not yet. So what will drive us off these highs? Okay, we would require a recession and an equity crash, right? Absent that, bond yields are going back up again. Right?
Julian,
We have another question here.
Julian, I'd like to make this statement. Prior to the current administration, we had inflation rates below 2%. Certain policy changes occurred that created the inflation that we're dealing with. What policy changes have to be implemented to address the change to get inflation down to where the Fed can reduce rates, but most important, the Fed and monetary and fiscal policy are not working in tandem. They haven't been. They've been adversely at each other. Therefore, you cannot get the full effect of rate hikes.
What's the question?
What are the policies that need to be addressed here in order to drive inflation down, yet not destroy the economy?
Julian?
Right. So, look, I don't have an axe to grind on this because I'm a non-voter in the US. But I would say that in actual fact, the first act of fiscal excessiveness occurred under Trump, right? We had a classic kind of pro-cyclical series of rate cuts that were politically driven, that were unnecessary. Now, don't get me wrong, I think Biden took things to an absurd level. And you're absolutely right that Fed policy and fiscal policy are at odds with one another. Although I will say that ultimately, you have to remember that since 1977, there's been a sort of third element to the Fed's objective, which is maintaining stable long-term yields. And so their ultimate objective may well come down to the solvency of their boss, right? They may have to at some point get involved as if we slide further into fiscal dominance. But to answer your question, what do we really need? We need fiscal rectitude. We need implementation of some form of austerity, so cutting back on spending and raising taxes. That's what you need.
Yeah. So Julian, so I might disagree on you there, but I think that there is, so people think we need rate cuts, but what they don't realize is there's a paradigm shift, right? I mean, some things are kind of like floating out there in the ether, keeping the market high, which are these 6 or 7 companies, NVIDIA, and then, the other companies, which really rely on us giving up more and more of our personal information to be able to get, high value, right?
Yeah.
With their advertising networks, right? So, I think that paradigm shift will play out.
Well, let's look at that.
So ultimately it will lead to the recession that you're talking about, right? So,
well, let's look at that, Marty. So as I've said, what typically drives bond yields lower, okay? And even then within a channel, which I suspect is going to play out something like this. So unchecked, ladies and gentlemen, by 2050, we're looking at 10-year treasury yields, which is close to 10%, right? And a low, which is close to 8, okay? So the trend is inexorably higher. And we've done a lot of work on this, and we can fill you in if you're interested as to why this trend is what it is, okay? Are we at risk of an equity correction? Well, if you look at US stocks on a relative basis, they have just moved into the statistically impossible range. We are at 4.4 standard deviations from the mean versus the rest of the world. Okay, that means the odds of this continuing are 99.99% against. Okay, note when this thing started to really accelerate was when the dollar started to accelerate and we started the post GFC expansion. And I haven't gone into this in too much greater detail now, but I can at some later point talk about why this becomes a reflexive self-reinforcing cycle. But that is the state of play. So to say that US stocks are not overvalued, extraordinarily overvalued relative to the rest of the world, is an understatement. Furthermore, ladies and gentlemen, we have some absolute clear bubbles. If it walks like a duck, it quacks like a duck, it is a duck. We have examined every single price bubble across all sorts of assets since 1929. They have very, very clear patterns with very clear components. You have a stealth phase, a discovery phase, a mania phase. You have a bear trap, consolidation, these parabolic blow-off moves, and then eventually you have a bull trap. And if we put the high in on NVIDIA last week, then we are probably in the beginning of the bull trap. And this is nothing to do with fundamentals, ladies and gentlemen. This is simply about ownership. When everyone owns it, the only way this thing can go is down. Okay? It is not about PEs. It is simply about ownership. Microsoft was growing into its PEs as Cisco was in 2000. Their PE peak was in 99, but in 2001, their stocks were down. In 2002, their stocks were down 80%. It is about ownership. It is about the transference of this period, which marks mania, which is greed, into fear. Now, we don't know for definite that's the case. We will only know once we get, if and when we get this sharp drop, and then it bounces and fails and we close the bull trap. That is the definition of when you have a bubble, when that bull trap rally fails. So we're not there yet. But I just want to remind you, if you are sitting there laboring under the illusion that somehow we can burst this bubble and go into recession and equities can miraculously stay up here, 90 years of data suggests that you will be wrong. The average decline in US stocks in a recession is 30%. Whether that's the mean, the modal, whatever it is, plain average, it's 30%. Okay? Now, finally, if the trigger is higher inflation, do not expect bonds to be your hedge for stocks. The reason that stocks are rallying at the moment is because bonds are rallying at the moment. And that's what happens in an inflationary world. If we have moved back to an inflationary environment, the correlation between bond and stock prices, not yields, prices, is positive. This actually persisted, and the Bank of England did work on this, that prior to 98, when we slipped into this deflationary world, where the correlation is negative, prior to that point, for 230 years, the correlation between bond and stock prices was never negative. It was always positive because inflation was the big risk. So if we are moving back into this world, then stocks and bonds are positively correlated. They will not be a hedge. Given this backdrop, there are certain things that we prefer to own because, ladies and gentlemen, bonds are now an instrument of confiscation. Okay? If you look at this chart, it is frightening. This is the total returns of treasuries, so including coupons. They have underperformed gold for the last, we've broken a level now, which we haven't broken for 35 years. Right? Now, that's why we prefer precious metals, because actually precious metals have held their own against the equity market miraculously since 2018. And indeed, look to be completing a pattern which looks very similar to the turn that we got in 2002 to 2003 when they really started to outperform. So we like precious metals, and we have liked precious metals for some time. The only thing that we need to be careful of, ladies and gents, and this is where timing is important, is that at least initially in the cycle, if we do have a bubble in NVIDIA, and the way this thing is going to resolve is an equity correction which leads us into a recession, and that's how you end up defeating inflation, because CEOs will fire people and all that high-end spending from consumers will evaporate, and then United Airlines will collapse in price because no one will be flying in the front end of the plane anymore and taking those European trips, okay? At least initially, the way that the correction tends to occur is nasty. So in other words, gold outperforms stocks, but it outperforms with stocks falling hard and gold at best holding its own, going nowhere, but it certainly doesn't matter. Only when the Fed starts to cut and the dollar peaks will we move into this nice reflationary phase. But at that point, you don't want to own US assets. You own everything else but US assets. So to sum this thing up, ladies and gents, we are in this really pivotal point where we need to decide which way we are breaking. If stocks recover and they keep going, then forget your rate cuts. Wages are going to remain way too high. The Fed is not done. Bond yields are going higher next year. And you can literally forget your rate cuts. Alternatively, if we have put the high in on stocks because they're just a bubble, then sure, you'll get your rate cuts as unemployment rises and CEOs fire people as their stock prices rise. But you will also get a swinging recession, a big correction in the equity market. And when it recovers, when the Fed starts to cut and the dollar weakens, you don't want to own the US. The US period is over, and it will be over as it was through this whole period from 2002 to 2008, 2010 to 2011, for a long, long time. There will be far, far better things to own. And they are extraordinarily cheap on a relative basis.
Can you name a few?
I mean, once the recovery starts, so you have to go through, Marta, you have to go through this nasty period where you have to manage your risk extraordinarily well, because even the things that you want to own in a VAR type event could go down, but you will want to own commodities, right? You'll transfer at some point from owning gold into owning more cyclical commodities. You'll want to own countries with exposure in commodities. So you'll want to own the Brazils, the Chiles, the South Americas of the world. And what you won't want to own is tech, because tech will be overvalued, just like it was in the dot-com bubble. It won't mean that it isn't transformative. It won't mean that those stocks won't rally. They just won't outperform on a relative basis.
Do we have more questions from the audience here?
Can you go back to the next slide after this one?
You want to go to the next slide, or okay?
This
I
one?
thought there was never mind. Thank you.
Okay. I mean, so I think you're supporting that we're going through a paradigm shift.
I think we
That
could.
people think we can just cycle back into the old way, and it's not so straightforward.
It's not so straightforward, Marty. I mean, we have not addressed inflation. The core driver of 2/3 of US inflation, core service inflation, is still above 5%. The only way that you get that down is if you create higher unemployment. So you create a recession, right? There is no way that we've never done it, where you just get a little bit of higher unemployment, right? You won't just go to 4.5% and then track side. It never happens, because a job loss it is a momentum indicator, right? Once it starts to go, it rises, right? It doesn't just go up a bit, it rises. The average rise in unemployment, there's probably a better chart on here. The average rise in unemployment in a post-war period is 3.3%, which would take unemployment from its lows close to 7%, right? It is never just a little rise in unemployment. The question is have we done enough? Is there a big enough equity bubble right here, right now to burst that? Because absent that, if this equity market cycles and keeps going through the election, let's say, Marty, right? Then we delay the inevitable, but your bond market is mispriced in that scenario, utterly mispriced.
We have another question. What's the question?
Actually, just comment, Julian, I wanted to thank you. The question about policy, it takes time. So the capital that's been sitting and has been there since the pandemic, we dropped trillions into the market. And secondly, innovation and productivity come slow. Microcomputer took 10 years to come into play, and AI will take, I think you said it's not today. It's not this 6 months.
Right.
So we had another economist speaking, and we're going to get to John in 2 seconds, but we had another economist speaking, and they were saying that the choice in the election is between a mercantile form of U.S. policy versus, continuing things as is. Any thoughts on that?
Well, I think, I mean, yes, you could, if you get a protectionist, I mean, which is really mercantilist, sort of an Asian style mercantilist, where you try and run a weak dollar and import restrictions, which is sort of Trump's inclination, and you shut down immigration. If I look at 2025 in that scenario, it's entirely possible you don't get any rate cuts at all. You actually get rate hikes. I mean, the forecasts that I've seen of the impact of, 50 to 60% tariff on China and a 10% tariff on anything else is core PCE rising 1.5%. Without foreign workers, wages would almost certainly rise again. And that's highly inflationary. So I know the equity market typically looks at Trump. I think they misunderstood Trump going into the last election. We got it right, thank goodness, because of our policy context that he was going to spend a lot of money. We were long US equities going, on the night of the election as they sold off. And but this time, I think people's expectations could be very, very mispriced. I think, people have not thought this through as to what this truly means. So my temptation, frankly, would be if you get a euphoric rally in US equities on ahead of the election on a potential Trump win, which looks to be the base case, my temptation would be to fade that, particularly anything that is very rate sensitive, because I'm just not sure that if the former president delivers on what he promises. And I will say the big caveat is here, he has not picked an economic czar. Yeah, he has not picked his treasury secretary. And there are some very smart people, who potentially could come in and may hopefully dissuade him from some of these policies that he's suggesting. But if he delivers on the manifesto, then you are talking at a very inflationary backdrop.
So my only other comment on the market is that I think that the global sentiment towards the U.S. tech giants is not positive from a regulatory point of view. So I think Europe is very, anti what the tech giants do, and I think that will just spread, around the world. So
I think one other thing I would just add on that, Marty, right? To go back to this comment that I made about the mechanics of this, right? When you run a very large current account deficit, someone has to fund it. When you run a large budget deficit and you don't save enough, someone has to fund it, and they have to fund it by lending you money or buying your assets. So foreigners have bought our assets. The trouble is we are increasingly sucking in a higher and higher percentage of the rest of the world's money to fund our excesses. At some point, Europe needs to rearm. Europe needs to fund its green expansion and its build out of tech. The same is true of Japan. And that money has to go home, whether the tax incentives that are offered to rearm or whatever, the money has to go home. And the question is where does it, and God forbid one day, for example, we wake up and the Chinese have decided they're going to spend their surpluses on, let's say, a national health insurance or some sort of greater safety net to support consumption. Because if they take their money out of the global bond markets, then it comes out of the US. And this is the singular problem, right? This is not about fundamentals, because what is driving these asset prices is flow. What will determine when this thing turns around is when those flow reverses, and that's a function of price action, which is why watching NVIDIA is kind of a fun little game at the moment, right? If this is a classic bubble and we have started the down move of the bull trap, that gets very, very interesting.
So there's about 2 minutes left. John Abellas, did you have a question?
Yes, I wanted to ask what do you think of the influence of the Fed in terms of money supply? I mean, they're withdrawing money by selling bonds and treasuries, treasury paper. Doesn't this have a moderating effect on all of this inflation outlook that you have?
The problem is, John, and you raise a very interesting point, is, and hopefully you can see this screen because I'm just trying to pull it up as we speak. The velocity of money is picking up, and the velocity of money is picking up very, very quickly. So if you look at the velocity of money, you can see, and it's interesting as to when it starts to pick up, sir. So if you look at this, I think one of the reasons that velocity of money was so low is because we had pools of excess Fed money just sitting dormant on balance sheets, unutilized. So what's been interesting is as the Fed has drawn down the quantity of money, the velocity is picked up to offset it. So the answer is yes, in theory, but in practice, actually no. And in fact, this pickup in the acceleration in M2 is actually quite inflationary.
But could not the Fed decide that money withdrawal should be accelerated in the face of unrelenting, increase in velocity? Because ultimately, money supply determines everything, right?
Right.
So,
I mean, the problem is as well that part of their problem is they've been trying to withdraw it as Janet has been trying to offset it. Right? Yeah. The velocity, the quantity of money in the system. We also had these dead pools of money sitting in the reverse repo and sitting in the TGA. And she's just, very craftily worked to undermine the efficacy of the Fed in trying to slow the economy down, because she's had a very different objective this year, right? Her objective is to get her boss reelected. It's got nothing to do with controlling inflation. This is why we're sitting here in the summer of 2024, years into a hiking cycle, and we actually have not addressed the core problem in inflation, which is core service inflation. And the reason we haven't done that is because we haven't created a recession and slowed employment.
mm-hmm.
Listen, Julian, we have other questions online. Hopefully you can answer them, but we have to cut it short at this point. Actually, not short, but we have to stop at this point because we are transitioning into this great discussion on energy, which was brought up by David Allen in a phone call.
I think it's a great discussion.
Yeah, 2 weeks ago, talking about how energy is so radically undervalued right now. Historically, energy companies have been a far larger part of the markets, of the equities, and they're at historical lows. So we have Tyson, Halsey, and Christine. But first, let's give you a big hand, Julian. Thanks so much.
Thank you, ladies and gentlemen.